So, hello everyone. My name is Mark Weissy of Maple Capital Partners, and welcome to the Raising Capital for Real Estate through Self-Directed IRAs event. This event is hosted by the AMG Mastermind. I hope everybody's in the right place, but I hope you came ready to learn about this exciting topic. Before we get started here, I just wanted to say a couple words about the AMG Mastermind, which is a mastermind that holds these monthly series of webinars on real estate education. So this mastermind, the AMG Mastermind, is a group of like-minded real estate investors looking to grow their portfolios through education, development, and networking. We offer educational opportunities, including shared group courses, content, and hosting speakers at our regularly held meetings like the one that you're on right now. So for today's webinar, we're going to have a very special topic, very special guests. All of us as real estate investors, syndicators, entrepreneurs, we all have at one point or another tried to raise capital. The guests today are going to speak about how self-directed IRAs are one of the best and most often overlooked ways to raise capital for your own and others' real estate deals. Our guests today come to us from Next Generation Trust Company, which specializes in helping investors, finance professionals, and operators to learn about and utilize self-directed IRAs in order to diversify their retirement portfolios, hedge against stock market volatility, and gain better control over their retirement assets. They're an accredited business by the Better Business Bureau, and they've won a number of accolades in their service to clients, including being awarded one of the best IRA custodians in America in 2019 by Wealth Advisor, as well as Mid-Atlantic Women's Leadership Awards 2018 winner by CEO Report. With that, Brittany, Jack, and Scott, I'll let you take it away.
Great. Thank you so much, Mark. Thanks, everybody, for joining. You can't see my face, unfortunately, but I'm going to be pulling up a visual presentation in a minute here that will guide you through the basics and concepts of self-directed IRAs and what you need to know to start getting educated in this space. So my name is Brittany Melville. I'm the Director of Marketing and Sales for Next Generation. And I have done many webinars like this, providing education to both individual investors, investment sponsors, and other financial professionals. So in speaking with Mark and team, there were a list of questions that they thought would be helpful for everyone to have answers to as part of the session. So what we did was we put together a presentation that addresses those questions. But of course, if you have additional questions, I believe, Mark, I believe there's an opportunity for everyone to enter questions in the chat area. Is that right? Okay. So we'll try to monitor those as we go through. The presentation itself should only take about 20 or 25 minutes, and I think we have an hour to be safe. So we want to leave plenty of time for open discussion and questions. So don't be shy with the questions. With that, I'm going to hop into it. I just need to share my screen. Can everyone see my screen before I get started?
Yes.
Okay, great. Right, so we're going to talk about real estate syndications and self-directed IRAs as it relates to raising capital for real estate as well. So just a quick overview on the organization and what our actual role is as it pertains to self-directed IRAs, because this is something that I think isn't automatically clear to new investors. Our role when it comes to self-directed IRAs is to act as a custodian and administrator for these retirement accounts. So we're not a brokerage house or financial planners or financial advisors, but we are a neutral third party that's responsible for holding these retirement accounts as a financial institution. And we're also responsible for all the tax reporting, all the documentation and record keeping on these accounts. And we are regulated by the Banking Commission of South Dakota, which is where we have our trust charter. Although we service investors in any state and actually any country we can, as long as they have U.S. income and a tax ID. So our reach is far-reaching, but we are regulated and we have certain obligations to the IRS to report information on these retirement accounts as well. Just as I had briefly mentioned, a quick disclaimer on what we don't do is we don't review investment's legitimacy or potential return on investment. That's something that the account holder themselves will do due diligence on and make a determination as to whether they're comfortable making the investments that they seek. And we're not fiduciaries. We don't provide specific financial advice. But what we do is provide education on self-directed IRAs, best practices, how the process works, do's and don'ts, the regulations that are important to understand, as well as making sure that we guide people through the process logistically to be as streamlined and efficient as possible. Quick background on the company, Mark mentioned already, our listing and wealth advisor. We also regularly contribute content to Forbes Finance Council, and our CEO and founder, Jamie Raskulinecz, has been with the company since its existence. So we've been in business for about over 15 years now, and we are a women-owned business based in New Jersey. We've been involved in many real estate investor organizations and associations over the years, as well as others. Self-directed IRA investments aren't limited to real estate, but it is probably the lion's share of asset class that we see. So we actually have run into market events. And Adam, I think we've run into you as well. I definitely remember crossing paths with you at some presentations that we've done. So yeah, we're very involved in the space, and we're very passionate about serving this group of investors. So in terms of how you actually define a self-directed IRA, for anyone that's not quite familiar, a lot of times people have heard of them kind of through word of mouth, but they may not be 100% sure what distinguishes one from a regular IRA. So really the biggest difference is what you can invest in. So typically with a regular IRA that most people are familiar with, that you might have with a Fidelity or the Schwabs or Morgan Stanleys of the world, you're limited to stocks, bonds, mutual funds, public securities, anything that's publicly traded. The self-directed IRA allows you to open up your options into what we call non-traditional assets or private, non-listed alternative assets. So that opens up many opportunities that you wouldn't otherwise have to hold in a retirement account. And this has been around since the inception of the IRA. It's been possible, but I don't think we'd seen a lot of growth in this space until relatively recently. And I'll talk about that in a moment in terms of the retirement landscape, but there's certainly been a lot of growth potential in the area of alternative assets in general, real estate being, falling into that category. So being able to invest in different things like this is one of the biggest distinguishing factors when we talk about self-directed IRAs. The other one is being able to do these types of investments while earning returns that are tax advantaged. So either tax deferred earnings on real estate investments, for example, or tax-free earnings, which isn't something you're going to get if you're using your personal funds. And then it also gives the investor the ability to choose their own investments. So they're not kind of limited to a menu of options with a brokerage firm or sort of pre-approved investments on a platform. They can go out, and if they have experience or they feel very passionately about a certain type of investment, whether it's private equity or it's real estate or it's private lending, they can go out and choose these investments that they feel confident in and believe will bring possibly a higher rate of return or return on investment than what they're getting in the market, which right now is very volatile, by the way. So this opportunity to invest in alternatives that are privately held tends to also stabilize returns in someone's portfolio overall in the long term. So that's yet another option. And then Mark had mentioned earlier too, the hedge against volatility by diversifying beyond publicly traded assets. The self-directed IRA as well, if you're someone who is looking for capital or you're trying to raise capital, is a huge untapped resource for a lot of investment sponsors. trillions of dollars in the retirement plan industry that are held up in these accounts that a lot of people don't realize they can put into things like real estate. So just to kind of lay the groundwork for the retirement landscape and why we've seen some growing interest in self-directed accounts is that retirement doesn't look the same that it did, maybe even 10 or 20 years ago. Social Security is not going to be enough for future generations to rely on as a source of retirement income, nor are we having the type of access to like qualified plans like pension plans, defined benefit plans that employers used to offer that would provide a lot more safety and security over the long term. Now most people have a 401k, if that, with their employer. And if they leave their employer, the 401k is no longer actively managed. So they have to do something with it. Otherwise, it won't continue to grow. So people are realizing this. And I think many people are recognizing there is a gap between where they need to be to retire comfortably at the age that they'd like to and where they are realistically. And we're seeing statistically here as well that for the first time in a long time, 20% of the population over age 65 is still in the workforce. So there may be a number of reasons for that, but I would think certainly one of the reasons would be that they don't have enough to retire. So this is sort of shifting the onus on people as individuals to start looking at ways that they can accelerate their retirement wealth building outside of just the old kind of traditional way of doing things. So in terms of self-directed retirement accounts, a lot of people sometimes think that there's just one account type that's called a self-directed IRA, and that's what you establish. But really, as we had mentioned before, the definition, or by definition, a self-directed IRA that allows you to invest in certain types of assets, but it can be any of these IRA types. And so these you might be familiar with. If you have any of your own, you might have one with a Fidelity or Schwab. You can also have these types of accounts with a self-directed company or self-custodian, which is what we are, that would allow you to have the same types of tax treatment and tax benefits, but allow you to invest in alternatives. So the traditional IRA is going to hold pre-tax dollars, and anything that you earn on those investments are tax deferred until you decide to take withdrawals. The Roth is going to hold after-tax dollars, but you're going to earn tax-free returns on anything that you invest, which is a great vehicle and a really unique tool for people over the long term to protect their earnings from being taxed. And then if you're self-employed, whether you're a real estate agent or you're a contractor, if you get paid on a 1099, you can establish a SEP IRA for self-employed individuals, which works sort of like a traditional, it's tax deferred, but it's going to enable you to potentially contribute more to it out of pocket on an annual basis because it's calculated as a percentage of what you earn from your business. There are also, as you can see, other plans here for business owners. I won't get into detail here, but just know that there are options, and we have more information on this if anybody were to be interested or wanted more education on choosing an account type. So in terms of getting funds into a self-directed IRA, I think one of the questions that, Mark, that you had sent out was like, who can open a self-directed IRA? Like, how do you, I guess, in a way, qualify for one? So essentially all you need to have is U.S. income, a tax ID number or a social security number. And then if you have a retirement account elsewhere, you can potentially move those funds from the account you have them into a self-directed account that you establish. So the first option to fund a self-directed IRA is to just make it an out-of-pocket contribution. And those limits are determined by the IRS. So if you have a traditional IRA, you typically get to put in $6,000 a year or $7,000 if you're over age 50. With a Roth, it's similar. However, it can be limited based on your income. If you, again, have a SEP, It's usually up to 25% of your compensation, not to exceed $57,000. So that's a much larger amount. But this is essentially a way of taking funds out of pocket and stashing them away into an account each year. Another way to move larger, amounts of funding, if you're looking to do a specific investment, is to either transfer from an existing IRA that you might have. So if you had an IRA at Fidelity, you wanted to take 50,000 of it and move it into a self-directed account, or any amount really, you can transfer those funds from the existing IRA to the new self-directed IRA. And a rollover, which I think was part of the question that was posed. So you may not have an IRA currently, or you may have an IRA and maybe you also have an old 401k from a previous employer that you haven't done anything with. You can roll over funds from that old 401k into a self-directed IRA as well, and then make the investment using that cash. And then just lastly, a conversion is really just more of a taxable event. If you were going to move funds from a traditional to a Roth IRA, you could do that as well. It's just going to create a taxable event, switching from pre-tax to after-tax dollars there. So on to the more interesting information. The possible investments that are allowed within these types of accounts. This is just a snippet of the possibilities, but these categories are the most common that we see, and a lot of different investments tend to fall into these categories. So real estate encompasses so much, but really it probably does make up about 65 to 70% of what we hold in self-directed IRAs in one form or another, whether it's direct ownership of property, whether it's private equity in real estate funds or private REITs, whether it's private lending or purchasing, non-performing notes with an IRA, tax liens. All of that is possible within the IRA. When we talk about private placements, we're just talking about private equity in general. So in addition to real estate, there's also the opportunity to invest in startup companies. That could be for any reason or any type. We've recently seen, with the kind of COVID situation going on, an interest in buying pre-IPO stock in certain companies that people believe are going to take off in this environment. So that's also an opportunity. Limited partnerships is another option for people that want to partner together into investments using IRAs, or a combination of IRAs and personal funds. Hedge funds, we talked about private stock, precious metals like gold, silver, also are options. Notes, secured or unsecured, international real estate, offshore hedge funds included as well. We've seen some interest in cryptocurrency, and then companies that have sort of more of a social impact angle as well. The only two restrictions that the IRS has here are that you cannot hold life insurance or antiques or collectibles in an IRA. So as long as what you're thinking about categorically does not fall into those two, then you're good. So obviously there are a lot of different ways you can get creative. But in terms of what we're talking about today, in terms of raising capital, the strategy would really be that whether you're someone who's interested in using your own IRA to do this, or you're someone who's raising capital, the investor would be using their self-directed IRA to make a passive investment, right? And what they would basically do is either purchase some amount of ownership or units of stock, however it's structured, in an entity or a fund, which is usually going to be an LLC or maybe a C corporation. The IRA would invest as a limited partner, or could form a joint venture, but if we're talking about syndications, usually it's going to be a limited partner. So the cash leaves the IRA, it goes to the entity. Documents are signed, obviously, agreeing on the terms of the investment. So then the IRA basically has title to a portion of that based on its investment. And then the IRA receives its return in the form of either dividends or maybe a portion of equity and however that investment return is defined in the subscription agreement, that is what the IRA earns back on its investment. So those funds would be then sent back directly to the self-directed IRA, and by doing so, those funds are tax protected. So the IRA owner is not responsible for paying taxes on that, as long as they're held in the account. This is sort of what I just explained, kind of the flow as it works. So the custodian / administrator, like a next generation, for example, is sort of the middleman in all this. So the IRA holder is not taking a withdrawal out of the IRA and then personally investing those funds. They're allowing the custodian to hold on to their IRA and the IRA funds, and then they are directing the custodian to make XYZ investment. So then the custodian takes those funds on behalf of them and the IRA, sends them to the entity, and same thing with anything coming back as an investment return is sent back to the custodian, who then deposits those funds into the IRA account holder's account. So by kind of not touching those funds, you're enabling them to get those tax advantages. So there are some, although this is all great, there are some rules and regulations that are important to be aware of. The IRS has outlined in the Internal Revenue Code when it comes to investing with IRAs, and they define some of these restrictions as prohibited transactions. So it's defined as an improper transaction between an IRA and a disqualified person. So I'm going to skip ahead for a second and talk about what are disqualified persons. So that would include yourself personally as the IRA holder, your spouse, and essentially any of your ascendants or descendants. If you're looking at a family tree, anything in kind of a lineal direction. So parents, grandparents, children, grandchildren. And then anybody who's servicing your account as a fiduciary, like an advisor, or any entities or companies that are majority owned by a combination of these disqualified people, and companies providing service to your account. So basically, excuse me, basically what that means is your IRA is not allowed to engage in a direct transaction with any disqualified person. And it's mostly due to the relationship and a potential conflict of interest when it comes to, are we doing what's best for the retirement account, or are we doing what's best for somebody else that's getting involved in the investment, that's leveraging the retirement account to benefit themselves? So there are 3 types of prohibited transactions. The first one is just directly a transaction between the IRA and the disqualified person. So it could be, the IRA invests into a company that is family owned. Maybe the company is owned by their parents, by the account holder's parents. That would be a prohibited transaction because the parents are disqualified persons. So really what you want to think about is using the IRA as an investment tool. It should be investing for investment purposes only, and it really should be more of a passive type investment in nature and not having an immediate benefit to yourself or anyone that's close to you in that sort of relationship sense. The extension of credit comes into play when we talk about lending money. So if the IRA is lending money to a disqualified person or anyone on that list, it would be considered prohibited. Same thing with borrowing, the IRA borrowing for from any disqualified persons. And then the last category, self-dealing, is more of a gray area, but this could be a case where the IRA makes an investment, but then other people are benefiting somehow from the investment. So an example of that could be the IRA holder invests in a company. They don't have any ownership of the company, but maybe they're providing consulting services to the company on a personal side, and they're getting paid a salary. And their IRA's investment is directly tied to that performance. These, again, it's more gray area, and these are things that your custodian's compliance team would be evaluating. So if you bring, it's always a good idea to bring an investment scenario to the custodian in advance of, what it is that you want to do, to run it by them. and let their compliance team take a look at it and get you some feedback on whether or not it would be prohibited. But understanding these basic rules is going to help you because you're going to understand kind of what general things are off limits. And it's good to understand that before getting into this. So here I just have some more specific examples of like what a prohibited transaction would look like if we're talking about a syndication or raising capital for real estate purposes. So if someone's using their IRA, they can't be an active partner, director, or managing member of that entity. So they should really be a limited partner only and should really be passive. And of course, those earnings get paid back directly to the IRA and not the IRA owner personally. And if there are properties involved in the investment, the real estate investments, they can't perform any sweat equity on the property. So no like physical repairs or adding value to that property if their IRA is invested in the property, whether it's directly or indirectly. So there was a question that came up in earlier discussions about UBIT tax or UDFI tax. And this is a type of tax that could apply to the IRA's investment. So it's important to understand this, and I'll define what this is and when it typically applies. UBIT stands for Unrelated Business Income Tax. And in certain situations where an IRA is investing and receiving ordinary income as opposed to passive, there could be a chance that UBIT tax applies. An example of this is going to be, someone is leasing a dry cleaning business with the IRA. So the IRA, is leasing this business and they're running this business on a day-to-day basis and they make regular operating income. That would be considered probably a UBIT situation because their IRA is getting ordinary income by basically running a business through the IRA, where other business space don't have the same tax advantages as an IRA would have. So that's an example of typically when that would apply. And then the UDFI tax stands for Unrelated Debt Financed Income Tax. This might apply when it comes to syndications. It may or may not. If there's leverage involved in purchasing a property associated with the entity. So that would include any rental income and capital gains. It would depend on how much of that asset is comprised of debt. So the portion that is considered debt is the percentage that would be taxed, without getting into too much detail. But we do have more information on this if anybody has more questions or wants to look further into this. If it does so happen that either of these taxes apply, then the IRA has to file a 990T tax return to the IRS. And that's something that a tax professional would assist with as well. So if somebody wanted to get started with a self-directed IRA, we generally say as a conservative estimate, the process usually takes from start to finish, like from account opening to you've made your investment and the funds have been sent out, 4 to 6 weeks. And the reason for that is several steps have to take place. So the first one is an account needs to be opened with a custodian. So in order to do that, the IRA holder, or the soon-to-be IRA holder, investor, I should say, completes an application. It's very straightforward. We do everything electronically. We use DocuSign. Other companies might have different processes, but essentially you would expect to fill out an application. And then it takes, our turnaround time is 1 to 2 business days to get the account open and assign an account number. So once the account is established, then we need to get the funds moved over. And that's a process that can range from a timeline perspective as well. Just because if the funds are held at another institution, we have only so much control over how quickly they will move those funds. If it's a transfer, we make the transfer request directly to them from our office on behalf of the investor. And depends on their processing times and whether or not they have any issues with that. It can take anywhere from a couple days to usually, I would say, a couple weeks, maybe, depending on whether the funds are sent by check or wire. But as long as the paperwork is filled out correctly the first time, and we're not dragging our feet on that with the investor, then we can get it done within a week or two. The good news is that while we're waiting for the funds to come over, we can work on the third step, which is getting the investment paperwork ready. So as long as the account is open, we can do that. We don't have to have cleared funds to be able to get started on that. So you can work in tandem with those timelines. And basically, in order for the investment to actually get processed or the transaction to be completed, we need to have the investor determine what they're investing in. As I mentioned before, they're doing their due diligence. So they're agreeing that, yes, I feel good about this investment. I understand what I'm agreeing to. I agree on the terms with the entity I'm investing with, or the company or the partner I'm investing with. And then there's paperwork that they'll need to complete and submit to us. It's a combination of internal paperwork that we have them fill out, like a direction of investment, basically. And then there's some supporting paperwork and documentation on the investment itself that we're going to ask for. And I'll talk about what that is in a minute. And then what we do with those documents is our compliance team, as I mentioned before, we have a compliance team, conducts a thorough review of everything for compliance with IRS guidelines. And so what we're looking for is the IRA labeled appropriately as the investor on all the documents? Do we see anything that would constitute a prohibited transaction by the IRS? That we wouldn't want that to happen. So if we see any red flags like that, we will go back to the investor and make sure that we get clarification or let them know that there's an issue. But once we've completed that review, we can then go ahead and process the transaction. So I talked about internal documents we would need. That's on the left side here. I'm not going to go into detail on all that, but it's basically just a direction of investment, agreeing that the investor understands their obligations in terms of investing in a private company, how they want to pay for the transaction, and then how they want us to send the funds out of their IRA over to the entity. If there's, their bank instructions, wire instructions and bank information that we need, they would provide that on a form that we request it from. And then the supporting documents for something like this would be, that we would need to review, would be an operating agreement for the entity, if it's an LLC or if it's a corporation. We just want to make sure that we understand what this entity does, what this entity is, who its principals are, do they accept IRAs, and then if we can get articles of formation or a certificate of good standing, whichever is available. And then, of course, the types of documents that your investor would sign anyway, subscription agreement, private placement memorandum that are outlining the terms of the investment, what they should expect to get. And then those we review and we actually sign on behalf of the IRA as a custodian, and the investor will mark them read and approved. So the investor agrees, we agree, the documents are good to go, and we hold on to those. So essentially that's kind of a high level, and let's see how much time I took here. All right, about 30 minutes. So that's a high level in terms of how self-directed IRAs work conceptually, who can have one, how you can get them set up, how you can get funds put in, some of the rules behind what you can and can't do, and the opportunities from an investment perspective. And really you can see that the benefits are on both sides, right? So whether you're somebody who has funds that you might be looking to put into alternatives, or you're somebody who's looking to raise capital and you want to make this an option that you offer to potential investors, obviously if you have the self-directed IRA, you're getting the tax advantages, you're getting the ability to invest in these types of things with a retirement account, not just personal funds. And if you're someone who's raising capital, you now have this huge network of potential cash tied up in retirement accounts that you can tap into. And some people may not have or want to invest their personal funds, but if they have money that's sitting in a retirement account not doing anything, they may be happy to use that. So understanding this is important, and it'll connect you with a lot of people. Obviously, it will diversify portfolios for the investors. And really for everybody, it's just something that whether or not you ultimately decide to use it is really good to know it's out there, because the more you ask people when you're networking, the more you'll find and be surprised by how many people know about this or are starting to use them or have accounts. So hopefully this has been helpful. Here is our general contact information. Our website, nextgenerationtrust.com. We have a ton of information there. Also, if you'd like to schedule like a one-on-one phone conversation, you can do that, and you can set it up through the contact us forms on our website, and we'll automatically schedule a call with Jack, actually, who's on the call from my team as well. If you prefer to just submit a written inquiry with your information, you can email us at newaccounts@nextgenerationtrust.com. Or you can call the office. We are mostly remote still due to the COVID environment, but all of our calls are either forwarding to ourselves or remote phone. So you're still welcome to give us a call and ask for somebody to help you with questions or setting up an account. So with that, thank you for your time so far. I know we have time left. So Mark, I can turn it back to you if that's okay. And if you want, we can go through any questions or we can engage in further discussion.
Yeah, no, absolutely. So looking at the chat here, we had a few questions pop up. I'll start with Bruno. He says, if I understand this correctly, I could use my self-directed IRA to invest in a joint venture or LP that in turn can purchase real estate together by using a custodian like Next Generation.
Yes, that's correct. And I just want to mention, I don't know if you're hearing it too, but I'm getting some feedback. I don't know if somebody's maybe not on mute, but it's a little bit difficult to hear the question.
Yeah, I definitely hear that on my side as well.
Okay. It sounds a little better now. So I think Bruno was asking, can I use my IRA to invest in a joint venture? And then what was the second half of that? I'm sorry.
Yeah, no, that's fine. To invest in a joint venture or an LP that can in turn purchase real estate by using a custodian like Next Generation.
Yes, that's correct. Yeah, the caveat to that per IRS regulations is that it couldn't be like an LP that you already own personally. So it would have to be one that's not like personally associated with you. But if it's somebody else's, then yes, absolutely, you could set up a self-directed IRA and invest in it, and then that company would in turn go ahead and invest in real estate. If you are doing a joint venture, like a partnership with your IRA, you could establish a new LLC, for example, that the IRA would be part owner of, and then, or single member of, actually, and then that LLC could in turn make real estate investments. So that's another way that you could set it up.
So as a good theme here, you basically can't benefit yourself or any of these disqualified persons generally.
Correct. Yeah, exactly.
Tay says, I believe one of the benefits from self-directed 401k is that it's not subject to UDFI. If qualified, would it be more advantageous in general to opt for a self-directed 401k over IRA, real estate investment?
Sorry, I'm getting feedback again. Are you hearing it?
I am hearing that. Okay, it sounds a little clearer now. So he says, if qualified, would it be more advantageous in general to opt for a self-directed 401k over IRA as a real estate investor?
Oh, okay. So self-directed 401k versus IRA. So I can't say that, I can't make a blanket statement that one is more beneficial than the other. I could tell you some of the differences that apply. A self-directed IRA is going to be tied really to an individual. And so it's going to be different from a self-directed 401k in that if you have a self-directed 401k, you have to own, first of all, you have to be a business owner to some extent to establish one. And then when you establish that 401k plan, it'll be associated with that business that you own. It will give you greater contribution potential because 401k contribution limits are $19,000 a year. And then you also have the opportunity to match that if it's your own 401k plan for your business. And so you can really max out at a much higher contribution every year, especially if you're someone who maybe doesn't have other IRAs, or you don't have, you don't work for corporate America and have a 401k that's sponsored by another company. So it'll give you the opportunity to put more funds away into it, whereas the IRA is going to only allow you, $6,000 or $7,000 per year. The 401ks also does have a benefit when it comes to that UDFI tax that we talked about. If you invest with the solo 401k, a self-directed 401k, the UBIT tax does not apply to your investments. So that is a big difference between the IRA and the 401k. If you think if the types of investments that you're planning on doing might trigger those types of tax. But you do have to keep in mind that with the 401k plan, you do need to have a plan administrator that maintains your 401k plan, whereas an IRA doesn't require that. 401ks are a little bit more unique and complex, so they are going to require that you have a plan administrator that you hire on an annual basis to do any unique tax reporting for those. So it's important to just understand the differences so that you can determine, based on what your plans are and what your situation is, which one makes more sense for you. So hopefully that helps a little bit.
So very, very based on the investor and their situation.
Correct.
Okay. So going along the same lines, another question: how flexible is it to switch among different types of plans under self-directed IRAs as your financial situation may change down the road?
That's a good question. So I'll take that under the assumption that we're talking about, like, if you wanted to switch from a traditional IRA to a SEP IRA, or maybe a traditional to a Roth, for example, you would have essentially the ability to really do that at any time that it makes sense for you. What you would just need to do is establish a new account in that account type that you'd like. And then if we already are holding the account, for example, the original account, we would have to just transfer the asset or assets from your initial account type to the new account type. If you are, for example, let's say you have a traditional IRA and then you want to open a SEP because now you're self-employed and you want to make larger contributions. Traditional IRAs and SEPs are both tax deferred, so there would be no taxable event associated with switching from a traditional to a SEP. However, if you do switch from a traditional to a Roth, you're moving your funds from a pre-tax state to an after-tax state. That is going to create a taxable event during the tax year that you make that switch. So that's something important to note. But then, of course, anything that you earn from then on, once the funds are in the Roth, is going to be tax-free. So it can certainly be done. It just takes a couple steps to make sure that you're doing it through the proper channels and that we're documenting everything appropriately for tax reasons.
Okay, great. Now I know everybody on this call is very diligent and does their homework and research generally, but just thinking down the lines of what happens or what if let's say you invest with a syndicator in a self-directed IRA, and you're supposed to receive your return from that investment in the IRA, but let's just say that they send it to you directly. What would happen in that case?
Great question. I love that. So we're saying a check should have been sent to the IRA, like a dividend check, for example, but it was sent to the individual person. And
Correct. Yep.
Whatever you do, don't cash it. Contact the custodian right away. Also contact the investment sponsor to let them know that the check was made out improperly. And the custodian can also assist with reaching out to that investment sponsor to give them the proper naming of your IRA. So every self-directed IRA has a naming convention, and it's typically going to look something like like ours would be Next Generation Trust Company as custodian for the benefit of John Smith IRA 1234. So it's going to have the beneficiary, which is the account holder, and then their account number associated with it. And it's going to have Next Generation in there somewhere, since we're holding these things on behalf of the person. So they would need to basically just cancel the initial check and reissue a new check. You just want to make sure that you don't personally cash it, because it would create a prohibited transaction. And sometimes people think, oh, well, let me just cash it and then I'll move it in to the IRA. But at that point, it's already been cashed as sort of like a personal benefit. So it would create a lot of issues from that point. So when in doubt, definitely contact the custodian before you do anything like that.
Okay, makes total sense. And in the interest of a lot of the people being on this call interested in syndication and in being operators themselves, how would you suggest, or how have you seen successful syndicators kind of approach the subject of learning about an investor that they may have and what their situation is, as far as, do they open it up with something like, do you have an IRA account from a past employer, or what have you seen as far as that conversation goes?
Yeah, so typically it's pretty simple, a pretty simple conversation. It would be, something like, and I think it's going to depend too on whether that person has an existing relationship or not, right? Because if you're soliciting a new investor, you could easily throw out there, do you have funds personally or retirement funds that you would be interested in using to invest with us, right? And then that might spark the question from them, oh, what do you mean I can use retirement funds? And then that becomes a conversation, which I think if you're raising capital, I don't think the expectation is that you're an expert on everything self-directed IRAs, but just that you have enough high-level knowledge to explain to them. If you have money in an IRA or a old 401k, you could potentially put it into a self-directed IRA that would allow you to invest it with us that way, and you're going to get tax advantages from that. And then what you can do, if someone shows enough interest from that initial conversation, is you can then connect them with the custodian or make an introduction for them to get further educated. So that's kind of what our role is, and how we can act as a resource to help, is if you can at least spark enough initial interest for someone to want to learn more or have a deeper conversation, then we're happy to have that conversation. Whether you want to be included or you just want to make an introduction and we can take it from there and keep you posted on it is fine. And I think then the other situation is maybe you have existing investors or people in your network that already know what you do, but now you want to offer this as another option. Maybe they have additional funds they might invest with you that are tied up in these accounts, and they didn't realize they could use them, right? So you can either have, depending on the type of relationship you can have a casual conversation about it, or if you want to have us present a seminar or something similar to this to a group of people, and you want to offer it as part of your brand and your value as well, to educate people in your network, we're happy to do that. We're also happy to send additional sort of electronic resources if you'd prefer that we just send some information that you can pass along to them. That will help as well. So I think there are different ways to approach it depending on you kind of just using your judgment as a business owner and what you think is going to be the right conversation for the right type of relationship that you have.
Great, thanks. Adam, you had a question?
Mark.
Yeah, can you hear me?
Yeah, we can hear you. Oh, spoke too soon. Cannot hear you.
Can you hear me now?
Yes.
Okay. Regarding UDFI, okay, and I know we had this conversation before. So the IRA money goes into let's say where the limited partners are. We have an entity, but the borrowing entity is the the special purpose entity that owns the properties, right?
Mhm.
So if the entity that the IRA money goes into is not the borrowing entity, then it shouldn't be subject to UDFI, correct? Does that make sense? Or
Yeah, so you're saying that so the IRA invests into a specific entity, but that entity isn't the one that's leveraging.
correct. There's a special purpose entity that's created that holds the property. So if you look at the org chart, you may have the GP here, LP here, SPE here. The SPE here could be, let's say, whatever property L. This is the property LLC, LP here, GP here. The property LLC is the one that's leveraging, not the limited partner entity.
Gotcha. Yeah. So there's a good chance that it wouldn't apply. But to be absolutely sure, it would probably be a good idea to pass that by either a CPA or a tax professional that works with self-directed IRAs or an ERISA attorney, just to get a solid opinion on that. Because ERISA attorneys are going to be able to interpret the code from a legal perspective in ways that we can't. And if it's a big deal or a big project, then it would be a good idea to get that sort of feedback. ERISA attorneys are well versed in all the law around retirement accounts and how they're used and self-directed IRAs. And although we don't have any in-house, we do have a number of ERISA attorneys that our clients have worked with on different matters. So we're happy to provide those contacts if anybody wanted to kind of dig deeper into that conversation.
Yeah, I think that would be great because I know this is a question that it's happening. Investors have, and if I could provide them a resource to help them with their comfort level, or if we can, that'd be advantageous for us.
Yeah, I agree because it's a big deal, right? To know whether or not that applies. If I were an investor, I'd certainly want to know that. So I'm happy to share that information, following this session or whenever you guys would like.
Okay.
Great, thanks. So I'm going
Hey,
to
Brittany, yeah, Mark, if you don't mind, I was just going to say, great presentation. I think you did a great job kind of giving a high level. And it's important to note, I guess, to reemphasize how much money is kind of locked out there into the Wall Street, kind of the ebb and flows of the stock market. So I think this is another tool in our tool belt for capital raisers to have that conversation. I do have a couple of questions from some investors of mine that I think you might have answered, but I'll kind of just go through it real quick. So one question is, as an individual with an IRA, should I open an LLC to use as the vehicle to invest into the alternative investment? How exactly does the movement of money occur? That's the first question.
Yeah, that's a great question. So basically they're asking, should I funnel my IRA investment through an LLC that I create? And there's no right or wrong to that. It's just understanding the differences between investing directly in the name of your IRA or investing through an LLC. If you're doing something like a syndication with your IRA, like you're investing into a syndication, there's really no reason for you to set up an LLC because it's just another set of steps you have to go through, and there is a cost associated with setting up the LLC. And basically how that works, though, just because they asked, is the LLC would have to be newly created, and it would have to be set up by an ERISA attorney who would draft an operating agreement. And then the IRA would invest directly into that LLC as either a single member or maybe a partner. And then in doing so, the IRA holder could be listed as a manager of the LLC. So that would give them access to the business's checking account for the LLC. And it basically just gives them what you may have heard of as checkbook control of their funds. Whereas if they're going directly through the IRA and using the custodian is monitoring every transaction, doing the compliance review, taking care of that, of processing the transactions and sending funds out and receiving them. Whereas if you put an LLC in the mix, it gives the investor more access to the funds, which I think if you're doing something like if you're actively investing in real estate with the IRA and maybe you're doing like fix and flips or something of your own, then that might be something that you might consider, because having access to the LLC checking account would help for like lots of day-to-day expenses that you might incur and lots of checks that you might have to write. And if you wanted to write them quickly, so that might be helpful. But if you're doing something that's very passive in nature, like the syndication, where basically your IRA is sending funds out and then maybe you're getting dividends monthly or quarterly, then there's really no reason for the LLC. It's just extra hoop and extra
Great, yeah.
spending. So
Great, thank you. The next question I have here says next generation is New Jersey based. Will they be able to service folks that are in other states? And if so, does that slow the process of funding into the self-directed at all?
So yes and no. So yes, we can service any state. We can service clients abroad as well. And in fact, we do have clients in Europe and Canada and other countries as well that we service. And it really doesn't slow the process at all, because everything we do is pretty much electronic. So the institutions that we're working with we're using the same processes.
Great.
So yeah, there's really no issue when it comes to that.
And then one last quick question, should be a quick one. Does Next Generation complete all paperwork necessary to fund the self-directed IRA?
So yes, as far as what we would need to sign off on. For the funding itself, if it's going to be like a transfer or a rollover, some of that's going to have to be filled out by the investor, because for security reasons, in order to authorize those things, the investor does have to sign off on them and agree to them. But we'll fill out our portion of those things to sign off as the receiving custodian of the funds, for example, and we will directly send out a transfer request so that the client doesn't have to do it. And then when it comes to the actual investment itself, we're going to make sure that we review everything, that we work directly with the investor and or the investment sponsor to see that everything was completed appropriately on their ends, and then we'll sign off on everything. So we do our part in signing off on what we need to, and then obviously taking care of the transaction for them by processing everything.
Great, thank you.
You're welcome.
Just a couple more questions here from people in the chat. I'm going to butcher this name. Vicus. I've heard that it's possible to take certain income out of a self-directed IRA, for example, dividends.
No.
Can you please comment?
No, that's not true.
I don't know who said that, but somebody chimed in. Basically, so let me simplify it. The way that IRAs work in general is the way that self-directed IRAs work. So if you have earnings in your IRA, you technically have the freedom to take them out whenever you'd like. The question becomes, what are the consequences of doing that? So if let's say you receive dividends that were paid back to you from a syndication, and you want to take a distribution and use the funds personally, you can do that whenever you want. No one can ever tell you that you can't have those funds. But if you take them out before the age of 59 and a half, you are going to be responsible for paying a 10% early withdrawal penalty. So that same rule is going to apply. It's an IRS rule. If you take them after the age of 59 and a half, that penalty does not apply. There may be exceptions to the penalty if you're taking a hardship distribution, first-time home buyers, things like that are, again, all determined by the IRS. So it's just a matter of looking into your situation and what might apply to you. But ideally, the idea behind doing this is that you're not touching the money until you reach retirement age, so that when you do take it out, you're only going to be responsible either for paying income tax on your withdrawal, if you have a tax-deferred IRA, or if you have a Roth and you take it out, it's tax-free. So really, the same rules would apply. But I could never tell you that you couldn't take the money out, of course, if it's your account.
Right. Okay. All right. So just be cognizant of the penalty, whatever it may be.
Correct. The tax implications. Yeah.
Right. Okay. Now, Tay has a question. Is it possible to move employer-sponsored 401k to a self-directed IRA while still being employed, or does it require an end of employment?
Great question. So I would say that 9 times out of 10, it requires termination of employment. But it's going to depend on your employer and the plan that you have. So we always do tell people it's worth asking, because there are some companies that even if you are employed with them will allow you to take a distribution. And if they will allow you to roll that over, then you could. Most of the time they will not, but it's going to depend on whoever is managing that 401k plan and how they've written up the rules that determine what you can and can't do. So your best bet, if you're not sure, is to either call up your employer, or if you know that, Voya, for example, is your 401k administrator for that plan, you can call them up and ask them, hey, is my plan eligible to roll over into an IRA? And they'll be able to tell you yes or no pretty quickly.
Great, thanks. Dan has a question here. Can any retirement money be rolled in, like 403Bs and things like that?
Yes. So as long as 403Bs, 457, pension plans, anything, we can accept anything as long as it is eligible on that end to be moved out of that plan. So that initial plan is always going to dictate what can be done with those funds and if it's permitted. Again, same rule with 9 times out of 10. If you're no longer employed by that company that had sponsored it, you can move it out. But again, there are certain exceptions. But yes, it does not have to be just a 401k. It could be other plan types.
Great. I think we're just about at the hour mark. So thank you again for your time, Brittany, Jack, and Scott. This was really, really tremendously insightful for everybody on the call, investors and syndicators alike. Want to really thank you so much for providing so much value. And for anybody who's thinking about using a self-directed IRA or maybe potentially raising capital by doing it, I urge you to get in touch with Brittany, Jack, or Scott, or one of their colleagues at Next Generation. I just want to reiterate, prior to this, I had to look it up because I was just curious. The amount of money in IRAs in the U.S. is $9.5 trillion. So that's $9.5 trillion that could potentially be available to you as a syndicator, as a sponsor, to raise for your next deal. So it's a huge amount of capital out there. And now you're equipped. Now you should be able to explain, at least at a high level, to some of your investors and hopefully start that conversation. So really thank you again, Brittany, for presenting. And lastly, if anybody on the call enjoyed the webinar and wants to be a part of the mastermind or has an interest in contributing, feel free to reach out to myself at mark@investwithmaple.com, and we'll go from there.
Thank you so much for having us. We appreciate it.
Thank you very much, guys. Great presentation.
Thank you, Brittany.
Thank you, guys.
Really,
thank you for the time.
Thank you so much. I loved your answer to my question. So that
I wish I could have helped you more, Adam, with when you were asking me about the UBIT, because Brittany's the master behind that. I was just trying to help your dad and help you get some insight into what he was doing with his. So I hope between what Brittany told you and I did,
we're good.
I just wanted to
all good.
I just wanted to bring up one more thing, just in case somebody tries reaching out to me directly. I don't want anything to get delayed. I am pregnant and I'm literally due in 2 weeks. So I will probably be I will probably be on maternity leave very soon. Obviously my team is ready and willing to help. Jack and Scott are on the line. I also have we also have another person on our team that can assist with some of the other technical questions. So please, if you try to email me directly and you get like an auto response, don't wait for me to come back. Feel free to reach out to them. Again, going through the website with an inquiry or emailing that new accounts at nextgeneration.com is going to get you to the person to help you. So just wanted to make sure.
I do have one question now. Let's say someone is unhappy with their custodian. They could always switch over to another custodian. That could be another option, right?
They can. Yeah, it'll be just a little bit more of a process to get whatever they have moved over from their other account. We would we would need to work with them and their existing custodian just to get the authorization. But yeah, that happens frequently enough, and it can certainly be done.
Awesome. Well, everybody have a great night, and thanks again.
Thank you,
Thank
everybody.
you. Be safe, everybody.
Good night, everyone.
Thank you, guys.
Have a good night.
Take care. Bye-bye.